So welcome this morning to today's webinar on consolidated financial statements and accounting for equity investments. My name's Alan Finnis. I think hopefully I can see a lot of people on the call who have been there previously, so welcome back. And for those of you who are new, welcome. I hope you enjoy the session. So today's session, as I mentioned, we'll be talking about consolidated financial statements and accounting for equity investments. Probably slightly shorter session today, probably 35 to 40 minutes, just to kind of give you a high level overview and some kind of work through a few examples and kind of an understanding of how we kind of treat this from an accounting perspective. If you do have any questions, feel free to shout in the Q&A function within the software, and we can address those questions either as we go or at the end. And if you do have any questions that you'd rather just ask me directly, feel free to send me an email. A copy of the slides will be sent following the session as well, so there's no need to take notes. And what I would say as well is we've been doing this for a couple of years now, kind of been putting on one every couple of months. The historical videos are all up on the website. So if you have kind of joined into this kind of process, and joining these webinars the last couple of months, all the historical back catalogue is available through the website, which takes you to a YouTube link, and you can watch those. So there's quite a few on there now. There's a lot of kind of key accounting topics: business combination, share-based payments, convertible notes, revenue recognition, impairment testing. So there's quite a lot there that you can kind of use as a toolkit. And if you do kind of run into anything on watching one of those videos and you want to have a chat about something, feel free to let us know, and we can go from there. All right, so we will get started today on consolidated financial statements. So I guess most of us who are on the call are responsible for our company and potentially a group account. So what we mean by consolidated is that there is more than effectively one entity controlled by the top holdco of the group. So say, for example, you've got a company which is ASX listed, for example. You might have a holdco, which is effectively the entity that's listed, and then that might own 100% of all your operating subsidiaries. So from our side, when you look at that, I suppose when it's quite straightforward. You obviously you group all the results together, then you process your elimination entries, and then effectively you have an end result, which is what you present on a group level. Couple of things to really discuss then in terms of those eliminations. That would normally be sign of intergroup charges such as management fees, interest on loans, actually elimination of the principal of the loan, and those kind of things that were pretty standard, and I think most of you have probably seen, so I don't want to dwell too much on that. If we do if we do control an entity, but we don't control 100% of that entity, I think some of you probably also have seen that that kind of gives rise to a non-controlling interest. So a non-controlling interest is obviously, say, for example, we own 75% of a business and the residual 25% is owned by another party. We effectively control that subsidiary based on our shareholding and a number of other factors that we will discuss as we go through this presentation. But just for argument's sake, we control that entity. We then consolidated 100% of the assets, liabilities, revenues and expenses. And then what you'll see at the bottom of your P&L statement and your statement of changes in equity will be a chop out of the NCI component, and that will be shown separately, and then they have their own kind of running balance in the equity accounts, which shows the position as at period end. There's a couple of other things here. So, and one of the most judgmental parts of this whole thing is, one, do we control an entity, and two, do we have significant influence? And if we don't, then we just call it an investment. So what's meant by significant influence and we equity account for something is when we do have significant power over the entity, but we don't necessarily control it. So we might have, a member on the board, or, a decent stake, 30-40% shareholding, and that kind of gives rise to significant influence. So we can kind of discuss that as we go through, because the accounting for that is quite different. You don't obviously consolidate the assets, liabilities, revenues and expenses, and you kind of hold the value as an investment, which then moves around depending on the result and any kind of cash contributions that are made. If we don't fall into either of those buckets, what we tend to have is a financial asset, an investment, which is accounted for under AASB 9. And I think I have done a previous webinar on that. So I will touch on a little bit of AASB 9 today. And it might be a little bit of a recap for some of you that have attended that webinar previously. But, I think it will be useful in the context of today. So I will move on. So definition of control. So the key accounting standard here is AASB 10, and that's been around probably since about 2013, I would say. So there was a big kind of transition in 2013 when they brought out AASB 10, 11, and 12, and that really kind of changed the way we look at control. Historically, I think it was more just about kind of shareholding, but they've kind of brought in these kind of qualitative factors which you need to consider when you determine whether or not you have control. So the key kind of statement in this standard is basically saying that we only have control if we meet all three of these criteria. So power over the investee, exposure or rights to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of investor returns. So again, there is significant judgment here. And you know, when we kind of break this down and you look at power, that tends to be the most important one, because the second and third one kind of, by nature, you kind of meet them if you do have power. So power is essentially, you know, shareholding, board seats, and it's not just those two things, but there's other factors. So say, for example, you know, an entity provides, say, for example, it's a software development business, and an entity provides staffing and support services to entity B. There's an impact there that effectively we do have some power, because if we pulled our staff, if we pulled our expertise, then that entity might struggle. So there's an argument we have power through other means rather than just shareholding or people on the board, for example. So that's a key point to really consider as you go through this. In terms of the exposure to variable returns, we're talking about dividend payments and profitability, etc. And I guess by our shareholding, by nature, we're exposed to those returns because we'll be paid out based on our percentage ownership. And then the ability to use its power over the investee to affect the amount of returns. And this kind of comes back to the point that I was saying about, you know, if we do provide services such as, you know, technical expertise, IP, if we decide that we're going to remove those aspects of what we're providing to this particular entity, then it's likely that we do have the power to affect the returns, because if we remove those staff, IP, etc., it's likely that the profitability of the business would drop. So there is a lot of judgment required, and I think one thing I would say is that there are a number of close calls that I've seen over the past few months, and it's also about not necessarily, you've got to draw a line in the sand and think, well, when's the appropriate time to this is significantly changed, and I think we'll get into that as we kind of progress today. So as I've kind of said already, so I won't, you know, percentage of shareholding, number of directors on board, and support for the entity. So that's kind of really where we're getting our power from, and that's kind of helping us to, you know, obviously direct the activities of that particular business. So this is just a definition as well in terms of returns and kind of where we're at. So obviously investor performance. So they can be positive and negative. So quite often in, you know, the space that we operate in at William Buck, we do a lot of work with startups, and, you know, those kind of entities, you know, they do tend to make losses in the first few years at least. So, you know, it's just to bear in mind that there can be a negative and a positive aspect there. Again, this is just kind of taken from the standard, and I think it's just useful because these are the really three cornerstones of it. So just really for your information there, just so that you kind of got that in writing. And then effectively, you know, if you do come up with one of these situations and you're working as in a particular, you know, accounting, you know, whichever company you're working in, effectively, you will have to probably write a position paper for either your kind of board of directors or your auditor, and these kind of 3 points really underpin your paper. So effectively you go through each one of these 3 points and then you kind of make a determination as to whether you controlled that. So that's just something to bear in mind for you there. So I've got a couple of examples, and I was just going to talk through these. So in terms of the first example here, I've got entity A as a 60% shareholding in entity B. Entity A has 3 out of 5 directors on entity B's board of directors, and entity A provides staff and technical expertise to entity B. So the first part of this question is, does entity A control entity B? Well, I think from our side, it pretty clearly it does, based on the discussion that we've had over the past 5 minutes. We've got a 60% shareholding, which is obviously a controlling stake. We've got 3 out of 5 the directors on the board, and we provide staff and technical expertise. So it's pretty clear that we have power impacted by the rights of return, and there's definitely a clear link between power and return. So in this example, we would say that entity A does control entity B. One of the questions here that I've kind of just added at the bottom is what if entity A's shareholding reduces to 40%? So if we reduce to 40%, essentially, we are below that 50% shareholding. So from that perspective, do we have power over the entity? And I think when we talk about this is when the judgment really comes in. And I think in this situation, you probably find you would still control it even at 40%. And that's on the basis that you do control the board of directors. So the board of directors are obviously in charge of governing the company and making all the decisions in respect to that company. And so in that respect, we would note that they probably do control it, but you would have to, there is significant judgment, and there probably would be an argument in either way. I think one of the things to also note is the other, and we will come on to this, kind of the other number of shareholders. So, if the top three shareholders are kind of make up a large percentage of the business, it might be less likely that you control it. And I think that's what we'll come on to in the next example. So something to consider there, and that's what I've just kind of come on to here. So control example 2. So entity A has a 40% shareholding, and the top three shareholders control 90% of entity B. The board of entity B has 4 directors, of which entity A has 2 representatives, and entity A provides support services to entity B. So in this situation, we don't necessarily control this, and that's really driven by the fact that, well, firstly, the board is split 50-50, and on top of that, our 40% shareholding, whilst it's a significant shareholding, if the top 3 shareholders have got 90%, it would only take those 2 shareholders to stop you kind of executing any particular business strategy or vote that was required at an annual general meeting or an extraordinary general meeting. Despite the fact they do provide the support services. So in this case, we probably say that they don't control, on the basis that the other 2 shareholders would have the ability to block the decisions that entity A may make. An interesting scenario here a little bit further down on the page is obviously if we own the 40%, but the remaining shareholders all sit on 1%, does that change anything? And probably it does, because effectively it's going to be much harder for those 60 shareholders, each holding 1%, to get to kind of a consensus to block a decision that the entity A may look to request at an annual general meeting or an extraordinary general meeting, and they could potentially put pressure on the board of directors. So this is one of the key things when we're looking at control, is really the makeup of the shareholder base, and how kind of much influence particular shareholders have. For example, we have seen companies where entity in this example, entity A might have a 60% shareholding, and the next biggest shareholder might have a 20% shareholding. But we say within the shareholders agreement, there'll be a number of kind of clauses which would require the 20% shareholder will be able to veto certain decisions, so such as things like business combinations, appointments of key management personnel, other significant entering into significant contracts without their approval. So even in that respect, when we have a 60% shareholding, because of the way the shareholder agreement's written, it kind of blocks these people, the majority shareholder, from actually controlling the business, because they have to get approval from the minority shareholder in order to execute certain transactions. So I'd say when you are looking at the judgment here, the shareholders agreement is very important, especially for an unlisted company where it tends to be a little bit more bespoke than what you probably find in the public space. So these kind of clauses are quite common, and I think it's almost just because if you go back to this, if you talk about entity A and you say, originally entity A may have had 100%, and then they've sold down 40% because they slowly want to divest from their position, and then as kind of a how should I say this? Kind of as a guarantee for the minority shareholder, we'll say that we'll consult you and we need your approval to do X, Y, and Z. So that kind of gives them an element of control. So that kind of has a quite significant impact on matters. And what I would say is, if you do have a situation like this, it's best to address it early in the financial year, like when it happens. Don't wait to the year end, because it can be quite judgmental. You probably need board approval, and also you need to make sure that your auditor and other advisors are comfortable with the position that's going to be taken. So hopefully that makes sense. I know there's quite a bit to take in there and there's a lot of connotations, but in general, I think the rule of thumb that I have is that, if we do hold more than 50% of the share capital, we have to explain why we don't control it. Otherwise, we kind of control it. And you can bring in, the board of directors, support services, other shareholder base, etc., to explain why. So that's just something to bear in mind as you kind of work through this if you come into a particular situation like this. So I'm just going to, sorry, just bear with me 1 sec. I'm just going to move the. Okay, so if we have a controlling stake in an organization, as I mentioned previously, we can consolidate 100% of the assets, liabilities, revenues, and expenses. All intergroup balances would be eliminated. Now, this is an interesting point in terms of disclosure, and I think, if we do control 100% of the entity, obviously in the financial statements, we have a listing of subsidiaries that we control and the percentage that we control, which is included in the financial statement. So usually these would all be 100%. And then if we do have, a 75, 60% stake, that will be where our NCI kind of comes in. Just to bear in mind, I think, obviously with general purpose financials, you do have to include the parent entity note. And I believe as well now with a simplified disclosure regime, which has been around now for 12 months. And I think, a lot of people have early adopted that, and they would also include a parent entity note. So remember that your investments in these subsidiaries aren't going to eliminate at the parent entity level. So your parent entity note will show value investments in the various subsidiaries. So what you tend to find with a parent entity note is that you might have, obviously, your share capital should reconcile directly to what's in the consolidated accounts because all the other share capital should have eliminated. You'll have some current assets, probably a bit of cash, and then your non-current assets will be made up predominantly of value of investments. And that's just something to bear in mind because you are disclosing that information. You still are actually technically required to assess those investments for impairment at the parent entity level. So just bear that in mind because sometimes, we do have kind of quite high valuations for these investments in subsidiaries, and we just don't really think about it because it eliminates on consolidation, but you do have to disclose it in the parent entity note. So it's something to bear in mind and just make sure the value of those investments is recoverable as you kind of go through your kind of, financial close process, you prepare your accounts and you discuss that with your advisors. So just an extra point there to bear in mind when we do consolidate into our financial report. So I'll move on now to significant influence. So if it's determined that we do not have control of an entity, we're required to assess whether significant influence exists. The key accounting standards in respect of this is AASB 128, investments in associates and joint ventures. A number of factors can determine whether significant influence exists. Representation on the board of directors or equivalent government body of the investee, participation in policy-making processes, including participation in decisions about dividends and other distributions, material transactions between the entity and the investee, interchange of management personnel, or provision of essential technical information. So one of the key points when we talk about significant influence is that whilst I kind of gave that rule of thumb about 50% for control, with significant influence, it's more like if you have more than 20%, you need to, the standard specifically states in 128 that you have to explain why you don't have significant influence if you hold more than 20% of the share capital. So this is a bit more clear cut. And I think the reason for this is that, AASB 10 is quite a new standard. It's not new now, it's almost been around for 10 years, but in comparison to 128, which is probably, at the turn of the millennium, that came out, it's definitely kind of a bit more, it's a bit more black and white, whereas as the standards have kind of evolved, there's definitely more judgment and qualitative kind of discussion that's kind of come into them, as I mentioned previously about the definition of power and such like. So this is very clear, and it definitely states in the accounting standard that if you have more than 20%, you need to explain why you don't have significant influence. So, and that's basically going along the lines of these dot points here in terms of representation on the board of directors, participation in policy making, etc., etc. So, it's kind of like. So that these are basic, and I think what you would find is if you do have more than 20%, it's likely that you tick a lot of these dot points. So it's just something to bear in mind as you go through. So I've wanted to go back to example 2, because obviously we've said that we don't control entity B here because of our top 3 shareholders are controlling 90%. So clearly we do have significant influence here. I mean, we do have a representation on the board, and we also provide support services. So ticking 2 of the boxes there. So in this example, we would have significant influence over entity B, and then likewise in the point below, we would control it as discussed. So this wouldn't come into play. So that's just kind of, there's 3, as I mentioned at the start, there's 3 things. Obviously, control it, significant influence, or it's a financial investment. So in this case, we've got significant influence over entity B. Excuse me. So this is just what I wanted to note, and I put this in writing because this is directly out of the standard. It does clearly say that if you have more than 20% of the voting power in the investee, it's presumed that the entity has significant influence unless it can be clearly demonstrated that this is not the case. Conversely, if the entity holds directly or indirectly less than 20% voting power of the investee, it's presumed the entity does not have significant influence unless such influence can be clearly demonstrated. And that's what goes back to the dot point says. So that's really our threshold for significant influence. So how do we account for this? So I think from our side, we've obviously seen a lot of these, in the space that we operate, especially at William Buck, we do see a lot of these kind of transactions, and so we do kind of build up a bit of a repertoire of how these work. So one of the things I would say is, on the second point here, in terms of how we recognize the investments, there's 2 kind of schools of thought here. There's 2 kind of scenarios. Either we purchase, say, a 30% stake of a particular entity, and in that case, we go straight into the requirements of AASB 128, which is the Equity Accounting for Associates and Joint Ventures standard. Having said that, there are situations where under AASB 10, we may lose control of an entity. So it goes from being a fully controlled subsidiary of ours to an entity where we have significant influence. So there is a difference there in how the accounting's done. It's kind of like a bit of a disconnect. So I have put there in the second dot point that we recognize the investment at fair value at the date the significant influence is held. That is in the case that we do a deconsolidation under AASB 10. If we just go out and purchase a 30% to 40% stake in a particular business, we recognize that at cost, which essentially would be the fair value anyway, because if we're buying something on a particular day, that would be what we purchase the investment for. So effectively your cost is your fair value, and that's why I have noted fair value there, but the standard in AASB 128 does say cost. Thanks, Jeffrey. So Jeffrey's just asked a question, and I'm just going to finish this slide, Jeffrey, and then I'll come back to that if that's all right. There we go. So that's basically how we recognize the initial investment. So if we've purchased, a dollar value, we can obviously trace that pretty clearly to a bank statement. The difficult part is really when we deconsolidate a business and what the fair value of that investment is, and usually sometimes we can hit the jackpot in terms of complexity, and the subsidiary does a spin out and lists on the ASX, and you've got an ASX price there, and it's pretty clear to determine what the fair value of the investment is on the date you lost control, because it's the share price. So that's quite straightforward. I think what I would say as well is that if it's not listed, usually we would have gone through a transaction to sell some shares, so you would have a price that the shares were sold for, so we can then work out what our ownership percentage is multiplied by the share price when the kind of transaction occurred, and that effectively is our investment. Going forward, the other thing that we would do is, if we did control it, would de-recognize any NCI, but I'll get onto that in a sec. At each reporting date, we'd also then recognize our share of the profit and loss of the investment. So say, for example, we recognize an investment and it's held for $5 million on the balance sheet or statement of financial position. We then go through a period of 12 months and the financial year ends. The entity may have lost $2 million, of which we own 40%. So effectively, we've got 800K of loss, which is should be offset to our investment. So the investment would go down to a value of 4.2. That would go up or down based on the profitability of the particular associate during each financial year. If it gets to a point where it goes down to zero, we don't continue to put the investment into negative, so it just stays at zero. And the only time we would recognize a liability is if we have a formal commitment through the shareholders agreement or such like to contribute resources, so cash or etc. So then we'd record a liability for that. Having said that, if we then basically just keep a running balance of the investment, and then if it does flip from loss to profit, we can start building up our investment balance again, and then we do assess that at each reporting date. The other point to know in AASB 128 as well is that we do obviously revalue our investment based on the profit or loss for the particular period and based on our ownership percentage. But if we do come up with additional indicators of impairment, then we have to factor that into our valuation as well. So you might find, for example, if we do a subsequent capital raise and if we do a subsequent capital raise and the value of the investment has substantially dropped, then you would almost take your share of the loss and then you take an additional impairment against that investment to bring it down to effectively what it's worth. So that's just something to bear in mind. And you can reverse those impairments, but you can't revalue the investment up further. So it's kind of like you can go, you impair it down, and then you can impair it back up to its original value, or reverse the impairment back to its original value, but then you can't go and take significant additional value there. So that's just something to bear in mind. So once you have set your investment, it's fixed, unless we get to a point where we sell down below the 20% threshold and we don't have significant influence anymore, and then we can bring it on as an investment at fair value in accordance with AASB 9. So I'll just step to Jeffrey's question. So Jeffrey's asked, could you discuss the difference between accounting parent, the legal parent, and RTO, and implications of having different parents? So I think Jeffrey, what Jeffrey's getting at here is in relation to, I think, a number of, it's probably less common now, but there are still a number of RTOs. And what I say about RTO is reverse takeovers. And that kind of does change things when we've got control. So effectively, you might have a legal parent, which is effectively the entity which is acquiring the other entity. But then on consolidation, the entity that's been acquired makes up a controlling stake of the overall group, and they control the board, and they may make up, I don't know, 70% of the revenues and such like. So then that generates what's called a reverse takeover. So it does kind of it is quite confusing for shareholders, I think. And, if we can avoid doing them, I like to avoid doing them, but I understand for whatever reason that sometimes they do happen. And effectively what happens there is that your financial statements, effectively the legal parent who's been previously reporting, their financials effectively kind of disappear, and the historical prior year becomes the acquired business. And then on the acquisition date, the accounting parent, which is a larger entity, is acquiring the legal parent. The ironic thing is then when you go to the parent entity disclosure note, it's the disclosure of the legal parent. So it kind of doesn't exactly marry up, and it probably takes a couple of years of financials for everything to kind of flow through and kind of get back to normal. So just something to bear in mind there. And yeah, just to thanks for that question, Jeffrey. It's interesting, and I think Jeffrey does a lot of work actually in the IPO network, and they do kind of do a lot of thought leadership around RTOs and kind of IPO capital markets transactions. So if you haven't been to one of Jeffrey's events, it's definitely worth reaching out to him, and I think there'll be definitely another couple this year. So they are great events, and I'd love to meet you as well. So yeah, if you are free, then feel free. I will continue now with this. So as I mentioned, there was kind of two ways that we can kind of end up having significant influence. One being the fact that we just go out and buy a portion of a particular business, and the other is if we previously owned 100% and then we lose control of that subsidiary and we become equity accounting. So effectively, when that happens, we derecognize the assets and liabilities of the former subsidiary. So we strip out, all our cash, receivables, inventory if we've got it, fixed assets, trade payables, employee provisions, etc. And then we recognize an investment, as I mentioned previously, at fair value. And we also kind of close out our non-controlling interest. So the running balance that's in equity, that will reduce to zero if there's only one kind of NCI, if we do have that. So like if we own 75%, we'll close out the NCI. If we owned 100%, there wouldn't be an NCI in the first place, so there will be no impact. But just to bear that in mind, obviously, if you lose control of a subsidiary where you don't 100% control it, there shouldn't be an NCI there. And if there is, you obviously need to close that out. So that kind of goes against the gain or loss in the profit or loss. So once you've kind of taken out your assets and liabilities, you'll have a net, asset or liability position. You'll recognize your investment, you'll take out your NCI, and then the balancing entry goes to it as gain or loss on loss of control of subsidiary in the profit and loss account. And we usually put that on a separate line item just so that it's clear to the financial users of financial statements, because sometimes it can be quite a big number in terms of kind of the recognition of investment, etc. So something to bear in mind. So if we move this on one step further and we go from, we've gone from control to equity accounting, and now we're talking about investments at fair value. So if we do not have significant influence over an entity, we hold our interests at investment held at fair value. So this comes under the requirements of AASB 9. They should be measured at fair value for the profit and loss on each reporting date. Now there is a kind of couple of get out of jail cards in AASB 9, which does allow you to continue to recognize things through other comprehensive income, and I do have a slide on that just going forward. I think what I would say is AASB 9 is probably one of the newest standards, only 3 or 4 years old now. It replaced 139, and it did change it did kind of make it a lot more not necessarily straightforward, but rather than taking a lot of gains and losses through OCI, it did make it kind of clear that in most cases you should be taking things through the profit and loss, and that was just kind of the most significant change in the standard, I would say. There are a couple of exceptions for the rule there, and I think from what we're talking about today in terms of valuation of subsidiaries and etc., we should the gain or loss would obviously go through the P&L. So we do talk about contractual cash flows here, and whether we need to make sure that they meet this test in terms of recognizing it. But for the case of what we're talking about with investments and such like, but they would meet that. So this is under AASB 9 how we would tend to kind of value these. So and what we would do. So in terms of if we've got an investment in something, it kind of depends on our objective, I suppose, and that kind of gives you what you should do effectively. So either you do either through OCI or fair value through the P&L, depending on the nature of the investment. So I guess if you've got a specific investment, probably consult with your advisor if it's not 100% clear what it is, and then you'll be able to kind of come to a consensus. What I think is important is that though, once we come to a consensus, we should try to be as consistent as we can be, and obviously you don't want stuff going through OCI and then some stuff going through the P&L. So it's better once you make the choice, either you're going to do the fair value through the P&L or through OCI, just bear that in mind. With no recycling, I think that just means that we don't recycle when we do sell the investments. The gain or loss on disposal goes straight into retained profits. It doesn't hit the P&L at all. So some people do that, and that's just the option election that you can do, but then you never get it through the P&L. It just goes straight into transfer between the reserves. So say, for example, we buy an investment for $1 million, and we revalues up to $1.5 million 2 years later. So normally under the fair value for the P&L, you take the 500k gain through the P&L. Under fair value through other comprehensive income and no recycling, you take a gain through other comprehensive income. And then if we sold the investment for 1.5 million, the whole amount would just basically go back through the reserves rather than hit the P&L, whereas with the P&L, any kind of final change in gain on loss would just go back through the P&L. So it's kind of how you want to present your financial statements. What we tend to see is that more trading entities tend to do P&L, whereas probably entities with less volume of transactions, they tend to go OCI. Like we've seen a few kind of mining companies that have a couple of investments in other mining companies, and they tend just to take the gains and losses through OCI with no recycling and elect to do that just because they don't want to distort their profit and loss from, you know, the primary objective of the business. It's also important to consider, you know, how big a matter these investments are in your, you know, the context of your company. Is it quite a small percentage? Is it quite a significant part? And then kind of go from there, I guess. I think the other point to note is that, you know, fair value is very important with AASB 9. So we do have to make sure that we've assessed our fair value appropriately. It is kind of judgmental, and it comes down to level 1, level 2, level 3, which I've got on the next slide, but you need to kind of make sure that you've assessed that at each reporting date and kind of go from there. So essentially, you on initial recognition, in most cases, the transaction price will equal its fair value. So at each reporting date, you need to assess it. So level 1 is quite straightforward. It's kind of ASX listed prices, quoted market prices, etc. Level 2 is more that quoted prices for identical or similar assets that in the markets that are not active. So if you have an unlisted company, you might find that they do a capital raise. So you could argue that this is probably a level 2. The other one is kind of level 3, and this is where we have observable inputs. And this is why it can be quite tricky. If you've got an unlisted company which hasn't done any capital raising activity, you know, in recent times, and it's material to your financial statements, you have to, you know, go through a lot of exercises in terms of working out what the value of that investment is, be it through, you know, an earnings valuation or a discounted cash flow or something along those lines. So it's quite a bit of extra work. I think the first thing, you know, from an audit perspective, you've got to make it sure before you start going through all this process that it's actually material to the financials, and you do need to actually do that. If you do need to do that, it is quite, it can be onerous, and a lot of judgments obviously involved. I mean, when we're talking about future cash flows and budgets and earnings multiples, there is a lot of judgment there. So you will be including that in your critical accounting estimates in the financial statements as well. So I guess just to kind of sum up, in terms of control, significant influence, and investments held at fair value, it's effectively, you know, if we have power over investee, we control it. If we have some impact on the business and our shareholding is more than 20%, it's likely that we have significant influence. And if we have less than 20%, it's highly likely that we've just got an investment at fair value. So that's pretty much everything that I wanted to say today. I think we're kind of on what I said, about 40 minutes. So if there are any questions, happy to take them. Otherwise, I guess, hopefully you guys have all finished your reporting seasons now, and you can kind of put your, well, not necessarily put your feet up, but hopefully get some time off and enjoy the next few weeks before we start ramping up again for June. Likewise, I will continue doing these webinars. I am thinking about doing some shorter presentations, which I'm going to put up on the website and the YouTube channel, which are more kind of 5-10 minute bites, just on kind of, you know, more kind of straightforward accounting topics like inventory, plant and equipment, accounts receivable, employee provisions, leases, that kind of thing, just so there'll be more short, sharp bursts, which I think might be useful to people, rather than kind of the long webinar, which is a fixed time. And as I mentioned before, this webinar will be up on the website hopefully today or tomorrow. So if you did miss anything and you want to go back, then feel free. Just got one. Okay. Thanks, Carly. Yeah, we'll definitely put a session up on leases. I think I'll do that definitely before 30 June. So thank you for the note. All right, guys. Well, yeah, have a great day, and yeah, take care of yourselves. All the best. Bye.